Mike Tedeschi, Wealth Management Advisor with Perspective Wealth Planning, and this week's market breakdown video. We're going to take a look at the four major U.S. indexes. We are also going to take a look at the U.S. dollar and commodities like we usually do. However, today's video is really going to focus in on rotation. Now, to talk about rotation, I want to start here on a chart of the NASDAQ. Now, from the high of 2 weeks ago to where we felt earlier this week, the NASDAQ had an 8% drop. A lot of individual components inside the NASDAQ saw some huge selling. We saw a lot of pressure in on tech. In fact, from Friday's open till Tuesday's low, the NASDAQ dropped 7% or so. All right, we've had a nice little bounce back up here over the last session, but we definitely saw money flowing out of tech names. Now, when we see big, strong selling like this from a leadership sector, which has been tech here, what we then have to do is take a look at what other sectors in the market are doing. If we're seeing broad selling across the board, then it might be cause for concern. But that's not what we saw here. Next, I want to take a look at the Dow. If we look at the Dow didn't pull back. From the high the other day to its lowest point during that big sell-off inside the NASDAQ, the Dow only lost 1.5%. As soon as that pressure was released, the Dow had a huge up day yesterday and finished up their all-time highs. This is what we call healthy rotation. Rotation means money coming out of one area of the market and flowing into another area of the market. It's very different than money just flowing out of all areas of the market. All right, that would be a broad-based sell-off. Bull markets thrive on rotation. One area of the market leads for a while, it pauses, slows down, money, profit is taken in that sector, and it gets put to work elsewhere, and that new area of the market pushes us higher. That's how bull markets work. And what we saw here this week was very clear, healthy rotation out of tech names, which some people might say are overvalued, into areas of the market that are going to best perform, so to speak, as the economy continues to open back up. Oil and gas names, airlines, and even banks. If we take a look at the banking index here, we put in new highs over the last couple of sessions. Markets do not have huge corrections when financials are leading us higher. And to take a look at that, we're going to look at the actual data behind that. If we look at the S&P 500, after 29% of financials were at 52-week highs, they're showing that leadership, we have a number of signals going all the way back to the 1950s. And out of all of these signals, a year later, we were only negative 3 times, with only one really large pullback, and that was in 1981. When we look at the data as a whole, it is very positive, a 6 months, a year out, with a very positive risk to reward skewed in favor of the bulls, right? Financials breaking out are usually a very good sign, and when we look at that data going back over the last 60 years, that certainly is the case. So, I know we have talked a lot over the last few weeks about a number of sentiment extremes and a lot of reasons why we might want to be concerned here with the overall market. But when we start seeing that broad-based rotation from one area into another, that makes us think that things are still healthy in the surface, underneath the surface, for at least now. We still have some under the surface concerns with the dumb money, smart money confidence indicator being as spread out as they are. As we know, that usually does lead to, at some point in the future, these converging back towards one another. Doesn't mean it has to happen right now. But again, when we saw money flow out of tech this week into other areas of the market, it was a little bit less concerning than if we had just seen money flowing out everywhere. Let's take a look at the other areas of the market. Let's take a look in at the S&P 500. We had that pullback in the S&P 500, not nearly as deep as the NASDAQ, but if we pay attention to what's going on from a trend perspective, we now have a higher low. We bounced well above our previous low that was put in on the 29th of January, so the uptrend is still very much in place. The Russell pulled right back to its breakout level, right? The breakout from the beginning of February right in here, right? This is the zone that we were watching. We got a breakout. What do? We back tested that zone and made a nice strong bounce. That continues its uptrend that's in play. So when we look at the technicals, they still look really good. Because even though we had money out of the NASDAQ, it went into other areas of the market. and nothing actually broke major support levels. Now, when we look at the U.S. dollar, the U.S. dollar has been under pressure here over the last few sessions and heading back down towards the low put in at the beginning of the year. What happens down here is really, really important. When we take a look at commodities, I'm going to start with one of the worst performers here over the last 8 months. That would be gold. Gold hasn't really broken down. It hasn't broken out. It hasn't done anything for the most part. When we look at it on a long time frame picture here, this is just a big push and then some sideways action. But this is not what you would expect with a weak dollar. If gold continues to act weak and isn't turning up, the weak dollar usually being a tailwind for gold, that's a bit of a concern. Now, the other precious metals are acting much, much better, and that's why we continue to take a look at them. Silver's back up in that 28 zone, looking like it might want to try to make a breakout over that 30. So since December, silver is clearly in an uptrend with higher lows being put in and higher highs, whereas gold continues to drift lower. We've got platinum, which we've talked about a lot, made a big breakout and has made 6-year highs and continues to push higher and is now setting up in a potential bull flag after this last run towards that 1300 zone. So it's acting extremely well. And palladium, which hasn't done anything for a year, is now pushing right back up into that 2500 zone. So we're still seeing positive action in the metals as a whole. It's just not getting that leadership from gold, and that's not necessarily a bad thing. All right, when we see leadership out of silver and platinum, those are higher risk, higher spec areas in that space, and that actually does bode well in the long run. When we take a look at copper, this has just been extremely impressive. We continue to talk about this. We had that break over that 380. We mentioned it last week. We're almost up to that 450 resistance point put back in 2011. This has been an incredible move, and a move over that would put us to blue skies ahead with no resistance to the left-hand side of the chart. We're going to continue to watch what happens here in copper. We take a look in at oil. I wanted to back this out and show you how well this has been running. That last high that was put in at the beginning of last year was about that 65 zone, and that's about where we're at. We have resistance from about 65 to right into that 75 zone, and then we really don't have anything until we get back up towards 100 because we had that big fall off from that 100 zone back in 2014. Right? So the action that's happening here still extremely bullish in the oil space, but it is running into some areas of concern from resistance last year right here at this point. What it does between that 65 and 75 will be very, very important for the future there inside the oil space. When we look at the emerging markets, they pulled back more like the NASDAQ than the others, but look what we've got still when we think about what an uptrend is. An uptrend is higher lows and higher highs. We still have that in place. So as long as the emerging markets can stay up over that 1320 zone, we did not make a lower low, and that would still have a uptrend intact. The last area that I really want to look at here is the bond market. All right, we're seeing real rates really head higher, which is not a positive for the bond market as a whole because they are inverse to one another. We have seen the bonds break down. We talked about the 166 level, and it has continued to fall sharply from that point. The next zone of support is really that 155 level, and then underneath of that really starts to become a concern. Next, I want to take a look at the 2 and 10 year. A while back, we were talking about the 2 and 10 year flipping negative and how that was a concern, and we did not stay negative for long, and as you can see here, we have actually just started to ramp continually higher here, and it's really started to take off in the beginning of this year. This is where we were at the beginning of the year, and we've really started to take off. This becomes a concern for the overall market when we think about it for one reason and one reason only. Right now, if you need a yield, if you need a return, the stock market is really the only place to do it with interest rates essentially at zero, right? If interest rates continue to creep higher, you get a return by having money in your checking account again, by owning Treasury and package securities. This will make some money flow out of the market from a risk perspective to take that guaranteed yield. So as we continue to watch what happens with the yield curve, it's going to be very, very important. If this continues to ramp higher, that could end up causing a reason for money to come out of the stock market. But overall, as we took a look, all the charts, we still have uptrends in place across the board in the indexes. And until we start making lower lows, that uptrend is still in play, and we need to trade accordingly. As always, guys, I hope you found this video helpful. If you have any questions, you can reach out to me at mtedeschi at Perspective Wealth Planning, or give me a call, 814-580-9881. Love to talk to you about anything regarding the markets. As always, I'll see you next week. Take care.